Okay, so in this recording, we're going to cover tax planning with S corporations. This is a really awesome concept. It's a really simple concept. At least I'm gonna try to make it simple for you guys. I want to, guys and gals, I want to start by saying that this recording is designed for the folks that are involved in our tax advisor series, our tax advisor platform, and so it's a little advanced. You wouldn't need to be a world-renowned expert in tax planning to understand this recording, but if this is the first time you've seen a tax return other than your own, for example, this recording might be a little too technical, a little too complex, but you still might be able to get a little bit out of it. But it's designed for folks that already have some tax background. So what we're doing here is I've got two tax returns for a sample client that we built in our tax planning software, tax preparation software. One of them, the one that says Schedule C sample, this is the example, and we're going to show the tax liability and the differences between the two, obviously. This is the one where there's no S Corp created, so it's just a self-employed individual making $100,000 in self-employment income. Married couple, one of the spouses is making $125,000 salary, $125,000 W-2, and then there's $100,000 in business income, and in this case, no S corporation, just a sole proprietor or single member LLC, for example. This return, we've got the same scenario, the same level of income, $125,000 salary. It's the same sample client built into our software. $100,000 in business income, but on this return, the $100,000 of business income is funneling through an S corporation. So let's take a look at the difference. And again, let's get down to the bottom line. Keep this simple. Feel free to follow up with questions, concerns, any of that good stuff. So on this return, we showed withholding $17,500 in tax during the year from $225,000 in income. Again, that's $100,000 of business income and $125,000 salary for the other spouse. So $17,500 was the amount withheld. And again, just this sample or example. And the amount owed, the tax liability, is $13,688. Okay? Now that's the S Corp side. That's with the S Corp planning. On the Schedule C return, everything being identical except not funneling the business income through an S Corp, we have, again, $17,500 is what we show as being withheld during the year, and but now they need to cough up $21,920 instead of $13,688. So let's just keep it simple and say there's an $8,000 difference. So we pay $8,000 more in tax just by simply not having an S corporation. And so I want to now, that just gives you a nice feel. This again, these numbers are going to change a little bit depending on how much business income, net income the business has, the other sources of income, how much income the spouse has, so on and so forth. But at the end of the day, I want to show you how can that be? How is there an $8,000 difference? How can you, funnel this $100,000 of business income through an S corp and pay $8,000 less in total tax? So I'm going to show you that, and then that will wrap up this concept. Okay, so on the Schedule C side, again, this is no S corp planning. We need to get down here to the self-employment tax Schedule SE. Okay, now what this shows us, self-employment tax is what causes, or let's say, self-employment tax is where the majority, or you could even argue all, of the tax savings comes into play when you let's just say funnel your business income through an S corporation. So it's in the area of self-employment tax, which is really FICA and FUTA, paying into the Social Security and the Medicare system. Okay, so you'll see here that the total self-employment tax is $14,130. Okay, now there's not the difference on the two returns is not exactly $14,130. So I'm not going to cover that that I'm not going to get that close to the page. I'm not going to get that detail on this recording. But there are some little details involved here in the tax computations and everything. That $14,130 is the amount of self-employment tax for the non-S corp example here. But the difference between the two, as far as total tax liability is concerned, is not exactly $14,130. It's about $8,000. Okay, but let's not go into that micro detail. Let's just focus in on self-employment tax is the thing. Okay, so that's the additional tax that's paid when you don't push your business income through an S corporation. So when we go back over to the S corp side and we see this about an $8,000 reduced amount of total tax liability, it sounds a little crazy, but what ends up happening is on a tax return, I just want to see if there was anything else here that was applicable, and there's not. So on a tax return, any net positive number on a Schedule C, which Schedule C again is used if you do not have an S corporation. If you have an S corporation, you have to file Form 1120S. It's an S corp tax return, and the net income as a result of that return. So S corp business owner has $200,000 in gross revenue and spends $100,000 total on all expenses. If they have $100,000 left over, that $100,000 of net income flows onto Schedule E. E is in Edward on the tax return. When you don't have an S corp and you're just self-employed, a sole proprietor, or a single member LLC, all of the net income is filed on Schedule C of the tax return. So you have Schedule C is in cat and Schedule E is in Edward. Well, for whatever reason, why the tax law is the way it is, that's a whole other recording. But it just is, okay? And the bottom line is that the income that a business reports, the gross revenue minus all the expenses and depreciation and all of that stuff, when an S corp is formed, that net income number flows onto Schedule E of the personal tax return, and that income is considered to be passive. And all that really means is you don't pay self-employment tax on that income. No 14.13% self-employment tax on those dollars. So on the non-S corp side over here, it's just the way the tax code works. If you show that same business income, $200,000 of gross revenue, $100,000 in expenses, and you got $100,000 left over in net profit, you pay 14.13%. You'll notice $100,000 in net income, $14,130 is the number you see calculated there. So it's 14.13% is what the net self-employment tax ends up being, until you get above the taxable wage base, which that's again another detail in another recording. But for now, just think about it real simply. It's a legal part of the tax code. Lots of little details. The S corp owner does need to have a salary, small salary paid out, which will have some self-employment tax applied to it. But in general, just keep it simple, and self-employment tax is the thing, is the type of tax, is the enemy here, if you want to call it that. And when you push your income, or you form an S corp, and you have all of your business revenue and expenses flow through an S corp, file the S corp tax return, do everything that's needed to be done to use that S corp entity, You just avoid self-employment tax on a very large percentage of the net income. And it's been rumored for a couple of decades that this loophole is going to be shut down at some point, and maybe it will, but it's not for now. This is totally legal tax planning to do, and can be very, very valuable for your business owner clients. And that is the general overview of how it works. And we'll have some more detailed recordings in the future as well to get into some of the finer points, but that gives you the general overview. Self-employment tax, yes, if you don't have an S-Corp, and no, or mostly no, if you do have an S-Corp. And it's a big number. The amount that we have to pay into the Social Security and Medicare system is quite large from a percentage standpoint, and that's where this planning comes into play. So, hope you enjoyed. Have a good night.